So Karen, the floor is yours. Thank you for being with us.
Thank you very much. Can you hear me? Yeah, okay. Yeah, first of all, thank you very much for having me and for letting me talk about my view of sustainable finance, ESG, and impact investing. And yes, let's start with what seems to be common knowledge. So there are a lot of meta studies out there that show a positive correlation between ESG and return. So the problem with this is that most of the so these are meta studies, so they are looking into the studies of other studies, and yeah, they are mainly comparing SRI funds. So when we start to take a neutral stance for a moment and say, well, okay, we do have the MSCI. We do have the Bloomberg ratings, sustainability ratings. So some companies have no ESG rating in the Bloomberg, but most have. They have a score between 0 and 1. And then let's do what Markowitz has done. Let's introduce a new variable. We call it theta. And let's do a Lagrange optimization on the entire MSCI using the Bloomberg sustainability scores. And of course, if there is no sustainability scores, then this will be 0. And then we will have more or less what we had before. So the classical markets optimization. If we don't take any view on the market, so if we are entirely passive, neutral market view, and what we can find when we do the Lagrange optimization, that you have to give up financial return for ESG. So now you can say, well, this is not really a good message. This is not the message that the ESG industry wants to hear, probably. Yeah. And so the authors of that study said, well, okay, you need an ESG allocation plan, and according to your preferences, then you can allot money to ESG strategies. And if this is the case, then of course it matters what kind of view you take. So you have to take a stance, you have to take a view, and then you have to understand investors' intentions. And you can see here now, I took that from ISS. Ethics, they did an analysis on what are the different approaches that you can take, and you see some shooting stars like impact investing, increase in funds by 79%. Then you can see thematic investing from a very low level, but having an increase of more than 200%. And you see also strategies which do not grow tremendously, like corporate engagement. Only 17% increase in corporate engagement. So let's assume for a moment, if you want to make ESG and impact investing a success, it might be not enough to just take a neutral stance. Because this neutral stance, as we see in the Lagrange optimization, may not lead you to a portfolio that thrives in the market. And let me also introduce a more distinguished allocation of impact versus ESG. So if you look in, because it's very often meddled, and the ESMA, the European Security Market Authority, just issued a statement where they said, well, ESG is not a consistent approach. I think we heard that from Matteo already. And we have to look into the issue, and we have to somehow harmonize it so that investors know, when they invest in ESG or when they take ESG as a component, that they have a clear, harmonized approach. Because if you don't have that, then of course it's good for investors. It's good for funds because you can do ESG arbitrage. You can see, well, which company rates this asset best, and then you do your ESG arbitrage. This would not be possible if you had a harmonized approach. So if we talk about ESG, what we very often take, or most of the time take, is ex post data from the sustainability reports. We have the Global Reporting Initiative. We have companies who really are very good in fulfilling all the guidance note criteria. Let's take as an example ExxonMobil. They are very good in this kind of ex post ESG. So they do have the governance, they report on environmental and social issues and how they want to change it, but it has no impact on their underlying. They are still producing oil. And then, of course, so this is what we see in the ESG world. And of course, then we can say, yeah, but we could do a time series analysis. We could look into it long term. We could say, well, if you have a carbon or decarbonizing strategy or climate strategy, let's see over 10 years how dynamic your decarbonization of your assets was. And that, of course, then is a risk lens through which we look, because we are looking into the carbon bubble. We want to reduce the carbon bubble, and then we have a de-risking strategy to de-risk our assets from that carbon bubble. And a very common example is the insurance industry, who is divesting coal. They are divesting coal as long as coal in a company's turnover is more than 30%. So let's take Glencore. Glencore is one of the biggest coal producers worldwide. And, well, the turnover of their carbon business is less than 20%. So you can keep Glencore in your portfolio if you have a de-risking approach. And this is what most institutions do. Because if you want to avoid the carbon bubble, and if you see ESG as a tool to reduce the carbon bubble risk, then you still can keep Glencore because it's less than 30% of the turnover. And so this is creating a little bit, inconsistent messages to the market. Now, when we go on and look into impact investing, then the common definition that we have is impact investing. Yes, I know all the charts where it says it's a journey, but impact investing, very often in most of the definitions of the impact investors, the real impact investors, they take a lockstep approach. So it is influencing the underlying. So it matters in what you invest. You would not invest in Coca-Cola. You would not invest in Nestle. You would not invest in ExxonMobil. All companies with a great ESG strategy, no question about that. So you would have a look. So do you solve a global challenge with market methodologies? And do you create financial returns based on that problem solving? And this is a completely different approach. And let's, for a moment, let's take Tesla. Are they doing that? Are they using market methodologies to solve a challenge? Let's say maybe particles in the air or something like that. Yeah. So the answer is yes. Do they have a good governance? Do they pay their workers well? Are they good on ESG? Probably not. So it means we need both. We need to have innovation and companies who are in impact, but at the same time still apply these old good ESG criteria. And so this is what we did. We said, okay, underpenetration goes hand in hand with sustainability. So we have to look into underpenetrated areas. And we created a fund, science-based fund, which is using a positive selection methodology. So we are doing active portfolio management. And we said, okay, we're looking for companies which are SDG driven and make 70% of their turnover is SDG aligned. The nice side effect is it's also taxonomy compliant. It can comply with Article 9. We also looked in, do they have a theory of change? So how do they integrate innovation? Something that investors should do. Innovation horizons. Let me be quick here. We look for additionality. So is it R returns, R is the business, R turnovers and profit. SDG aligned, is it intentional? And is it material? So every challenge is a business opportunity in disguise. This is not me saying that. This is Peter Drucker who said that. And so if we look into the challenges, we can find a lot of opportunities. So we created a positive selection methodology, which is only looking into companies which are liquid, so they are trading on the stock market, at least in New York and in London. And we created a portfolio with cosine matching where we said, so this is entirely ESG compliant. When we look into, so you can see the sector allocation, I'm happy to share that afterwards. And now, well, so here's the elephant in the room. When we look into, the geographical allocation, so the first thing we said is we exclude with governance context. And then, of course, when you exclude with governance context, when you look into innovation approaches and the ESG approaches, you end up in Europe very much. So our performance simulation shows, we use dynamic hedging here as well, I have to say that we had a better performance than the MSCI, based on an active selection methodology, based on impact, plus the ESG integration. So my message to you today is take a positive approach, use impact plus ESG, and well, we can discuss whether this is possible with a passive approach. Thank you very much.